Mortgage rates came in at 5.98 this week, which is a record low since about 2022. So the question is, what does that mean for the housing market?
I don't think it makes much difference, in my opinion. I mean, you think about where rates were, and I guess they were at this price, what, in 2022?
Yeah, in 2021, they were 3%. 2022 is when it spiked to 6 to 7. It's almost 7.
Right. So people are trying to get back to those old times, but it's good from an optic standpoint to crack that 6 number, I think. That's good, but it's 5.98%. So I'm sure that that's good in some respects to say that they're now in the 5s, even though they're barely in the 5s. But the reality is how many people are still going to, this is going to help, obviously, don't get me wrong. It'll definitely help people that are looking for mortgages, right? And it'll definitely help pick up the phone and, try to convince people to do cash out refis or whatever it might be. And they're trending in the right way. That's all good. But to unlock the real equity that's sitting in people's homes, it has at least 1.5 to 2 points to go.
Yeah, I mean, I was super happy this weekend. I locked in a DSCR loan for 6.25. And I mean, we haven't seen those rates. When I had my lender quote it 2 weeks ago, he was quoting me at 6.8. So it was a pretty significant drop for me to be able to do 6.25.
Yeah, I mean, obviously things are trending nicely, right? And the new Fed chair doesn't come in till May, I think it is.
Yep.
So I think it's going to be a really interesting year because I think they're going to be battling unemployment. I do think unemployment's going to continue to rise. It could potentially get up over 5 soon based on, everything we're reading. People are cutting this year, ironically, due to AI and all the efficiencies that they're finding around all of that. But so that's going to really, really be interesting because the Fed, remember, they have two dual mandates. One is the unemployment rate, which is at mid 4s, let's say. And the other is interest rates. So it's going to be very, very, very interesting to see the way the administration handles this one.
Yeah. And if you really look back in 2019, because, we didn't talk about interest rates as much back then as we do now. So I actually didn't even know what the standard interest rate was. So 2019, it was 4%. And then it was in 2020 that they took it down to 3% or lower, right? But so now us being at 6, we're still not back to those 2019 levels. And the question people are asking is, could we get there? Because they are significant savings. I mean, even we were as high as almost 7, and now, we're at 5.98. So that is a significant savings for people over the past year.
It's just 1%, I guess, really. But you have a point. I think you got to go back and look at, in my lifetime, what we saw in 21 and 20 was a gift, right? And I think that, it created a bunch of addicts, basically, right? A bunch of people that made money on the mortgage business and made money on the home sales, and it pushed home sale prices up, right? As it does, as low rates are addictive, right? I mean, there's just so much stuff that can move. And so now what's happening is this is, post detox, right? They're detoxing, and they're trying to go back to the way that it was. And I get it. So 7 to 5.98 is certainly good. Don't get me wrong. And I'm sure it's going to move the needle in many, many, many ways. But at the same token, it doesn't really move the needle like we need, because there's so much on the lock-in effect, right? There's so much money sitting under 5%, that it's got a ways to go. There's actually a lot of money sitting under 4%. So I think unless rates get down into the low 5s, this is just going to be a flat year.
Yeah, but let's talk about, could we get back to the 4% that we were, in 2019? Because that was before, I agree with you. I don't know if we can get back to the 3s, because that was, they were throwing everything at COVID to try to make it so the market didn't crash, and they overinflated it. But, to get back to that 4% that we saw in 2019, I mean, is that possible?
Well, you bring up a heck of a point. So, let's talk about what the pandemic and COVID did, right? Like they lowered the rates, obviously, but then, to try to stimulate the economy, right? That's essentially what lower rates necessarily is. And by the way, it's interesting because this morning I had a podcast with George Gammon. He said, low rates means that the economy's not doing great. Like some people think the opposite, right? Like, let me say that again. When rates go down, it typically means that they're trying to stimulate the economy because it's not doing great. Okay. So you got to kind of wrap your head around that, right? And so right now, the economy's actually okay generally, right? We're not really out of bounds on unemployment, and inflation's somewhat manageable, and rates are sitting here at just under 6. So when you lower rates down to that much, it typically is going to be responsive to things like higher unemployment, right? But then what do low rates do? They create bubbles. So just like they did before and before and before and before. So, there's a time to utilize those low rates. Like if you could borrow below inflation, then you should, right? And just lock in. But people, they're sitting on these below 3% debt, which is a lot, millions of people. Why would you're not even looking. You're like, okay, it's still about 6%. It's like twice as much. And so, there's just a long way to go. And I just think that it's nice. Don't get me wrong. It's awesome that they've come down almost a full point. But I just don't see it unlocking that much. It's going to kind of keep things. It's like releasing a little bit of air out of the balloon. That's all that's happening.
But the market is pretty stagnant, right? So I think what people what Trump would love is for people to be able to go out and get houses again and be motivated to get houses. And, one of the big things in order for the Fed to start lowering rates is, making sure inflation is under control. Because while it is definitely better than it was, we're still having these inflation spikes. And there's just a lot of things that inflation is a big deal because, to your point, the Fed has to balance inflation and unemployment. And, they've been more, aggressive at lowering these rates a little bit because unemployment is going up a little bit, but also because inflation has been in check. So if inflation starts to go up again, I think they're going to pump the brakes on it.
And now a word from my paid sponsor, PadSplit. Look, if you've been trying to make single-family rentals pencil out in this market, you already know that the math can be tight. With high rates, properties that would have cash flowed 5 years ago now often break even at best. So what do? You wait on the sidelines and miss out, or maybe you find a better model? That's why I want to talk about today's sponsor, PadSplit. Here's an example of the math in some markets. A 4-bedroom renting for $2,700 as a traditional rental may be able to gross over $6,000 a month in a co-living setup through PadSplit, depending on location, occupancy, and costs. The same house can potentially more than double the gross revenue in the right market. And before you think, that sounds like a headache, PadSplit helps with member screening and rent collection while still allowing you to operate the property and make management decisions. This is one strategy investors use to try to make deals work when traditional rentals don't pencil. If you want to see the numbers for yourself, go to padsplit.com/hosts. I'll have a link in the description. Just run the math on the property you already own and see if it's a fit. You might be surprised. Well, I think Trump's blind spot is going to be unemployment. At least we haven't seen much on it. It might not be, but the reality is he's super focused on these low rates. By the way, he's a real estate guy. He's an investment guy. He gets it. Like, low rates will stimulate the economy for sure, but it'll also create bubbles. So I do think he's going to continue to push, obviously, even though the Fed's supposed to be independent. I do think that he's going to continue to push just like he did in his first administration. So what does that do? It definitely unlocks things, right? It's going to unlock people that are sitting in their 5s, right? And want to trade laterally or maybe even up, right? But if you're sitting on, don't forget, there's also the prices are significantly higher than when people locked at those rates. So, a $500,000 home today was probably in the 350 range back when they had these low rates. So not only do they have a low rate, but they have a low mortgage. So they're sitting on all this equity. So for them to make that stretch, they not only have more to mortgage, because if you're doing a cash out refi and you're getting 100 to 200 more at a higher rate, it's a significant difference, right? And I just think that I don't think it's going to unlock like we think.
Well, and I think too, Trump's blind spot in my opinion, is inflation because, he's been really forward with the tariffs and those didn't create the kind of inflation that, people projected. But now, his tariffs got ruled illegal. So he has to navigate that. And then, like I said, this war with Iran. So I think that inflation could easily get away from him if he's not more focused on it.
That's a heck of a point. I mean, obviously, we're all concerned about the war, right? And as we should be, right? I mean, we're in unprecedented times here. So, and the one thing is for sure, if you go back and look at when the U.S. has been involved in these kinds of things, inflation rolls through the economy, whether you like it or not, because there's government contractors that are supplying things for the war. Of course, we don't know how far or how little will be involved, but this is going to be something to watch. I do think at the same time, we have this kind of undercurrent going on with AI and tech, and and big companies are announcing cuts, massive cuts, across the board because they can do things more efficiently with less people. And so we just don't know where that's heading. And I actually think that before we know it, we're actually going to be up over 5% unemployment.
Yeah, and we talked about that on our live on YouTube on Monday. Now I wanted to go back to 2019 because I wanted to kind of compare what was different then than now. Because if we talk about rates going back to 4%, we have to compare of why that would be an issue when it wasn't an issue in 2019. And I think the big one in 2019 was inflation was under 2% or was at 2%. And I think that's a big deal because all growing up, from the time I graduated college and I was squeezed, I was in my 20s until 2020, I never really cared about or monitored inflation because I never felt a lot of inflation.
Yeah, I think that's common because I got to tell you, I personally, oddly enough, I'm very focused on it now, but for the longest time, I just didn't consider it, right? You know what I mean? Like I'm not shopping for a family, groceries, right? And I'm not back then I wasn't really using my car for these, for work and for all the things. And I wasn't that concerned with, all the rising prices like insurance and property taxes and all those kinds of things. And I wasn't really plugged into the economy that much, right? Until, I think probably into your 30s and going into your 40s, right? Really, I mean, seriously, like some people do, some people start earlier than others. But the truth is it really starts to show up, in your 30s and your 40s, right? I mean, you start to really see that when you start to have a family because everything's more. That's when you start to really, that's when you start to tighten your belt. You start to look at how do we cut back on things. You start to look at alternatives that you used to do at the grocery store. You start to look at different ways of travel. You start to look at giving up your car instead and just Ubering because of the price of owning a car. And so those are all things that people are going through right now.
Yeah, because, back in the day when inflation was 2% or 2.2% or 1.8%, it didn't really feel super significant. I mean, things always kind of went up a little bit, but, you'd have to look at it over 5 years for it to go up 10% typically. And so that's very incremental. But, starting in 2020, 2021, we were seeing like 7, 8, 9% inflation increases all in a year. So, every time all of us went to the grocery store or filled up our gas tank, or went to buy a car, everything was just crazy expensive. And so we didn't have that in 2019, and we hadn't had that for a long time in 2019. So for us now, the Fed has to look at that before they just start dropping rates. Is this going to spike inflation again? Because right now inflation is kind of sort of under control. I mean, it's teetering, but it's not as bad as it was. And so but people are already scarred. I mean, it's like, okay, we already had a, 9% year over year inflation increase. So now even 2% more just feels like, oh my gosh, things are going up even more, but if it's 3%, I mean, that's 33% more than they allowed before. So I just think that, that is a big difference. And I think that's why you won't see anything aggressive because I think they're, especially with this war, I think they're going to be even more, slower to pull the trigger on lowering rates.
I don't know. I think you think about what lowering rates does under this administration. It just unlocks so much money sitting there, trillions of dollars. And, people traditionally aren't very good at managing their money. Like, let's just be clear on that. I mean, our personal savings rate is at an all-time low right now. And went up during COVID when everybody got their stimmy checks, and then it went right down, and then the credit card debt went way up over $1 trillion. Now it's significantly, it just keeps moving up. So essentially, everybody's buying on credit, right? And they're getting into debt, and I just don't think that what happens is, I think when you unlock for a lot of people, when you unlock that money, it's not very frugally spent, right? Like they're buying trinkets, RVs and boats, and some people are doing improvements, and some people are doing investments, and some people are starting businesses. So I don't want to just throw a blanket over all of this, but there kind of has to be a purpose of the money. If you're going to borrow it at 5 and you're going to do a cash out refi at, let's say 5, if you're lucky enough to get 5, an additional $100,000 to $200,000. There's a cost, right? And so the question is, do you buy a depreciating asset? Do you buy, doodads, I guess, which Robert would call in his cash flow game that they do at Rich Dad. So those are the things that you got to watch. But I will tell you one thing that it does do when you unlock all that. It's essentially like everyone getting a $50,000 or $100,000 lottery ticket, right? That's essentially what it's like. Okay, so what do they do next? They go on vacation, they upgrade their car, they go buy, things. And so that does trickle into the economy. I actually think that's what they're trying to do, is if we can get these rates down and people can, unlock another 50 to 100 grand, even stay in their existing home, just unlock some of that money that is sitting in their home right now. The question is going to be, what are they going to do with that? And if history proves to be, what it's going to do in the future, then I think that that's going to be spent on all kinds of stuff, and it's going to stimulate the economy, vacations and air and hotels and all that kind of stuff. You'll see. It's the same thing that happens when people get a tax refund, which happens. How many people do you know that actually talk about their tax refund going into their bank account? Like, what they do is they talk about what they're going to do with it, right? So that's essentially same thing. If somebody comes into money, they blow through it very quickly.
Yeah, and I just to show what a difference, these rates can make. I mean, just from my, say you had a $500,000 loan. I mean, just from going at 6.8 to 6.25, you're saving a couple $100s a month. But if rates were to go to 5%, which, they could over the next year, then you're saving $400 a month on a $500,000 mortgage. And to be honest, that's significant for people. That's a deal breaker for people. I work with people and we're solving to their monthly payment. And if they can afford a little bit more for their money, then they're able to actually buy something that they want.
Yeah. And by the way, I do believe rates are going to go down, and I do believe this is going to happen. I do believe this is going to get unlocked. But at the same token, I also believe that we're going to see higher unemployment this year and into next. And so, could it be like a net? You know what I mean? Like, it could be. It could mean that the economy doesn't really move too much.
Yeah, and I mean, that's a good point. We're not going to see lowering rates unless we have some kind of recession. Now, how bad will that recession be? That we don't know. But I mean, if the unemployment numbers start to go down or, remain low, you're not going to see as much rate cuts as if they start to go up. But we're anticipating that they're going to go up because of AI, because businesses have slowed down. And I think, I forget who said it, but somebody was interviewed last week and they were saying that, these companies are blaming AI, but they're just kind of a scapegoat for them wanting to cut back, which could be true as well.
Well, I think probably both is true, right? But we have, I mean, there's all kinds of really smart people that I had dinner with somebody last week. We did that said that they believe that we're going to be in double-digit unemployment in 18 months. Okay, so think about that statement. Now, they could be completely wrong, of course, right? But this is somebody that has hundreds of AI patents and works in Silicon Valley and is looking at it very differently than, than us, right? And so, again, it's just a conversation. Doesn't mean that it's going to be true.
So there's kind of two scenarios here. Like we both kind of agree rates are coming down. There's scenario A where they come down really slow and really cautiously. And then there's scenario B where they drop quickly, just like they went up quickly. And I think that is going to really depend on how the economy is doing, on which one of those things they decide to do, and how inflation is doing.
Yeah, I think yes, inflation and unemployment. Those are the two. Those are the two big unknowns, right? We could see inflation. Typically, inflation does take a year to 2 years to actually show up. If you just look, you'll see. Same with rate cuts. Like you can see that there's a lag with all of this. Like if you take a look at when we hit 9.1% inflation in 2022, that was actually from the pandemic. That was actually from the stimmy checks and a whole bunch of other things. There was a bunch of money thrown at businesses and individuals, and that showed up. It peaked in June of 2022, right? So there's lag. There's lag when money hits the economy, and there's lag when interest rates hit the economy, and there's lag when interest rate cuts. But the one thing is for sure, if we're starting to see unemployment creep up and we're starting to see inflation creep up even more, then I can assure you they're going to try to combat that with lower interest rates.
Yeah, and you brought up the lock-in effect for sellers, and if sellers, this is why Trump wants the accelerated, right? He wants all of that equity unlocked. He wants people to be able to move, to go, a big family to get a bigger house, a first-time home buyer to be able to get in the market, a retiree that to want to sell and downsize. But right now, like because everything's so frozen, there's no incentive for that family to upgrade houses. It'd be way too expensive. There's really not much incentive for this retiree to downgrade houses because they're really not saving that much money. And the first-time homebuyer's priced out. So he really wants to fix all that. So the aggressiveness is what he wants because he sees how much is locked up and pent up and how much that would stimulate the economy between mortgages, between title companies, between realtors, between, movers. I mean, everything. Like real estate's a huge part of our economy. And so he sees all that, but we're just going to have to wait and see, how this unrolls. I think May will be interesting because that's when the new Fed chair gets in, give him maybe 30 or 60 days and then but I also think Trump really likes the big announcements. So it's like, This is my Fed chair and we're rolling this out and this is what we're going to do. So it'll be interesting.
Yeah, I don't know. It's clear we can't get around this affordable housing problem, right? And so he's been talking a lot about it. 50-year mortgage, portable mortgages. He was talking about using your 401k money and your retirement funds and all this stuff, and and he just keeps taking bullets, on those issues. But he keeps throwing all this stuff at the wall to try to figure out an affordability play, a way to unlock equity, and a way to get people into housing. I actually do agree with that kind of vision. It's going to be very interesting on how we get there. If you go back and look at the administrations before, Clinton had an American dream vision, Bush had an American dream vision, Obama had an American dream vision. So America, and typically that American dream is owning a home, and so I would bet that there's going to be something rolled out more along that line. There's going to be programs or policies that get people into homes, because we cannot have a nation of renters moving into the next decade, because what will happen is the decade after that is going to finance them, right? What's like, you guys all know I talk about my mom all the time. My mom was a hairdresser. My dad was in construction. I grew up in a great family, but at the end of the day, they hardly have any savings, if any, and most of their money is sitting in their home, right? And their home is paid off, and that's just it. And so what if they didn't have that? What if they were renters for life? They would be in big different type of scenario. So that's actually what I'm most concerned about, is that like we need to get these youngsters, or not even youngsters, just people into that home. They need to start paying down their mortgage. And I'm saying this as a landlord. I mean, we make our money on renters, but the reality is it's not good if people are forced into rentals.
I think the other thing you have to talk about is, I'm looking at some stress in the housing market, but the stress in the housing market are not people that typically bought in 2020, 2021, 2022. The stress comes when people bought at these 7% rates, 2023 to 2025, let's say. And the ability to refinance out of that could save a lot of people from having to short sale or having to foreclose, because they really just need to save a little bit of money every month, and then they can afford to make their payment.
Yeah, but here's on the other side of that. Um, you know, there are people that bought at those rates, and when rates go high, that means the asset prices kind of stabilize. So there's a whole bunch of people that bought during that time when higher rates actually kind of slowed down the market. So it's possible that a lot of those folks made really good purchases. They just have this high debt issue, right? And so there's an opportunity perhaps right now to lower your payment by 1.5 when it peaked in about the mid sevens, right? Because right now we're in the high fives, basically call it 6%. So, and that could be significant as well, where they can significantly lower their payment.
I think the biggest thing is these FHA borrowers. And, we talk about this a little bit on our channel. A lot of them only put down 3%. And the problem with that is that home prices have corrected a little bit, not a ton, but enough that it's going to be hard to refinance without putting more money in. And a lot of these people don't have the money to put in. So that will be, and that's why the FHA is in such a bind right now, is because of how little they put in and how expensive their payment is.
It's all going to boil down to that equity, right?
Mm-hmm.
Like, because if they put a little bit of down payment, and to your point, the home price didn't really move that much, then I think, of course, they're going to be in a precarious situation. The interesting thing is, if you look at history, I think 3 to 6% home appreciation is about right. Like, the problem is, once again, the addict got used to, post-COVID numbers, and, they went from, homes went from 300 grand average to over 4, very, very fast. And why did that happen? It happened because rates went down to 3. So, so low rates can push prices up even more. And we've done this comparison before plenty of times where, we're still in the low 400s. And if you go north to our Canadian friends, let's say, they're in the 7s, right? And that's significant. I mean, you think about the difference, right? 300 grand more. Imagine. So I'm not trying to compare ourselves with them completely, but it's very, very interesting when you start to look at all the factors when you're restricting new construction. Rates are adjustable, or in that case, they're only 5 years and then they reset. Their immigration policies and all that stuff basically drove housing up, if you take a look at it. So as we start to unpack that and unwind that, what people want is they don't want to lose money on their house. They want their house to go up. At the same time, they want low rates. Well, they're fighting each other, right? Because low rates drive prices up. As we start to export immigrants, whether you like that or not, that's exactly what's happening. Does that free up housing? Maybe. Does it free up rentals? Maybe. But the reality is that all that stuff is disruptive to real estate, and all that stuff is creating some of what we're seeing today. I'm actually a fan for a lot of it, because we need affordability. Period, right? And so the one thing to cure affordability are more homes. And the only way to get more homes is to have really, really good interest rates. So, the person next door can build some and add to the inventory, in a neighborhood near you. So, or a big home builder or whatever, even though their cost of funds are pretty low. The low interest rates unlock progress. But it also creates bubbles.
Yeah, and I really do think that we should focus on this FHA issue, because the 2008, the big catalyst was obviously the adjustable rate mortgages. And I do think FHA is going to negatively affect some of the stuff with their default rates, because they barely put any money down, and these interest rates and payments are just really squeezing them
Yeah.
much more than
Yeah,
conventional.
there's no question. And I the one thing to watch, guys, is going to be the default rates, right? You've got delinquency on the rent side, which could happen as a result of job loss, of course. We saw that during the pandemic when unemployment rates went over 10%. And we could be heading that way, right? On the other side of the equation, to Daniel's point, those are the same things that could start to jump some of these home default rates right now, because they're actually quite low right now. If you look at, post-pandemic, or I'm sorry, pre-pandemic, you start to look at that. We're not that high. You go back to 2008, 2009, it was nuts, right? We had 4 million homes on the MLS. Right now we have 1 million, right? Just to give you some perspective. So we have 3 million less homes of supply. Okay, so more supply drives prices down. And so it's kind of holding the line. And that I like that market watch report that took 100 cities around the country, and it looked at them all. It said which ones went up, which ones went down. There were 78% or 78 of the cities actually went up, or 78%, and 22 of the cities actually went down. They retracted. And you can guess who those are. Those are a bunch of the cities in Florida from the Airbnb pop. Those are some in Phoenix, certainly, in Dallas, in Atlanta, in Nashville. You start to see these, there are some cities that are retracting. So if you're there, that's what you see. But if you go somewhere else, you might see something different. And so I think you got to look at, the submarket you're in. There's certainly ones that are trending up and certainly ones that are trending down. But we are in no way any type of a crash.